And welcome to ETF Edge. This is your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Dave Nadig of ETF.com, John Davi of Astoria Portfolio Advisors, regulars on ETF Edge. Let's kick it off with a huge week for earnings. All eyes will be on the FANG stocks. Facebook, Amazon, and Alphabet all out with reports. These tech heavyweights make up roughly 8% of the S&P 500 market cap weighting. Three stocks, 8%. Think about that. So aside from the obvious SPY, SPY ETF, what other ETFs could see the biggest impact from these reports? Dave, this is your area of specialty.
Sure. So if we're talking about broad-based ETFs, really, 8% is about what you're going to find in most big, large-cap ETFs. If you look at things that focus, say, just on the internet space, though, like the First Trust Internet Fund, which is FDN, that's 23% in these names. Now, that may sound like a lot, but you start getting into some of the sector funds that own these, like communications or retailers, and individual stocks there can be 23%. 23% of, for instance, XLC is in the two Google share classes.
John, is the FANG moment come and gone? Have we made too much of these five names? Should we start moving on and get other acronyms? I know Jim Cramer has been trying to come up with a few. He's always very good on this, and he invented the FANG.
Yeah, I think you want to shy away from FANG and cyclical and growth stocks. I think you want to lean more on like stocks that have strong earnings, high quality stocks. That's the premise that we've been riding in our portfolios all year, and I think that makes a lot of sense. So.
Where should we go from here then? So I have complained mightily for years that these stocks get too influential in these indexes. The five FANG stocks are 1/8 of the S&P 500. Five stocks, and there's 500 stocks in the S&P. The top 10 are 21%. I know I've complained about this. Is there a reason for us to be worried about that?
I think so. I mean, as you get bigger in size, market cap, then you're going to be a bigger driver of these indices. So my whole premise is to invest away from market cap, to invest in factors, quantitatively driven ETFs.
Yeah.
So.
But you tell me to calm down. Every time I bring this up, you say, Bob,
look,
please.
There are plenty of ways. Well, first of all, there's a reason that people generally cap weight, because the market sort of self-corrects these things. But I think it is reasonable to be concerned when we get to frothy markets and these high concentrations. There are lots of ways to insulate your portfolio from some of these moves. You can buy reverse cap-weighted ETFs, which effectively will underweight things that are over present in the S&P, or you can just go into any number of factor.
Has that ever worked very well, underweighting the reverse cap weighting?
It effectively turns it into a mid-cap fund, and definitely when we see these big, large-cap momentum names like a Google, Amazon, Facebook, when they inevitably fall out of bed, the mid-caps tend to be what come up and pick up the slack.
So it's good contrarian play if you believe they're going to fall down.
100%.
Okay.